You're listening to The Money Hour with your host, Tina Mitchell, and co-host, Keelan Harvey on Alternative Talk AM 1150. Now, back to the show with local mortgage experts, Tina Mitchell and Keelan Harvey.
You're listening to The Money Hour at 1150 AM KKNW, the Friday, January 15th virtual show. Because of COVID-19, our show is temporarily moved virtually. You can also listen to us on podcast or on air at 3 p.m. or on a rebroadcast on Sunday at 8 a.m. I am your host, Tina Mitchell. We bring into studio each week the best of the best experts in our local market on everything regarding your money, and we're here to help you in today's economy. And right now in studio, we have Sarry, Ibrahim of Financial Asset Protection. Grow your wealth passively, regardless of the market conditions. Again, right here on 1150 AM KKNW. Sarry, thank you so much for joining the show. Excited to have a conversation with you.
Hi, Tina. Thank you so much for having me on.
Absolutely. A little bit about Sarry. Has made it a mission to inform as many people as possible on how they can grow wealth regardless of the market conditions while still having liquidity for other investment opportunities. Sarry's goals is to show individual business owners and real estate investors how they can leverage their money, take control of their financing terms, and have a predictable and tax-favored retirement plan. Sarry graduated with an MBA in 2016 from Keller Graduate School of Management in Chicago and has been in the financial services industry since 2015. He is a member of the Bank on Yourself community. I love that. Always a great topic to talk about because finances are so important because your quality, and that's one of the, the reason for this show is we really want to bring in the best of the best in every expert that has to do with anything regarding money, because that's how you're going to have the best quality of life for you and your family and be able to contribute like you want to your community. So how can someone grow wealth passively regardless of market conditions? That's a statement.
Right. So pretty much it starts with one concept. It's called the infinite banking concept, also known as the bank on yourself concept. And pretty much what this concept is, it's kind of counterintuitive, and a lot of people don't see this coming. It is the utilization of dividend paying whole life insurance. Now, we're not talking about whole life insurance just for the life insurance purpose, but rather for the living benefits, for the cash value benefits, and being able to use this alongside your business, your real estate portfolio, or other investments you have, or even as a savings plan in retirement. The difference between using this strategy and using other conventional strategies is that it is not affected by market conditions. And also it creates guaranteed liquidity regardless of market conditions and regardless of your financial situation. So pretty much we have a whole life insurance policy. You're building up cash value in it. You have dividends and interest. And you also, more importantly, have access to these regardless of your financial situation. You never have to qualify for these loans. The policies are self-collateralized. So pretty much that's what it is. It's using infinite banking pretty much for retirement purposes and within your real estate portfolio or other investments that you have.
Yeah, and I think there's people that are listening today that think, well, you know what, it would have been really nice to actually have my assets protected and not to lose in the down market. So how long has the Bank of Yourself concept been around?
Well, it's based off of whole life insurance companies that have been around for over 160 years. These insurance companies have been paying dividends, interest, death claims, cash values out during that time, regardless of, during the Great Depression, during the 2000 crash, during the 2008 market crash, and even right now through COVID and what happened last year, they're still paying out dividends, interest. They're not affected or hindered by those market conditions. But the bank on yourself concept specifically has been around for the last 20 years. It's more of a modern twist or a modern spin on whole life insurance, because whole life insurance kind of has this negative sense to it where it's kind of a terrible investment. And it could be. It could be a terrible investment if it's not structured properly. This concept isn't in reference to all whole life insurance products across the country. Currently, there's about 1,200 insurance companies, but only 3 of them could use this strategy that will help you grow, save predictable wealth regardless of market conditions, while also being able to use it within your real estate portfolio or your stock portfolio, or even as a retirement plan if you're a full-time employee. It's not an either or solution. It's not either, I put my money in whole life insurance or I put it into real estate or I put it in the stock market. Rather, it's an integrated approach where you could fund the whole life policy, borrow from it, fund your real estate, pay back the loans via real estate profits, and then be able to pretty much recycle the money over and over again. So it's not necessarily meant to replace other types of investments or HELOCs or other things like that people are already doing within the real estate portfolios. Rather, it's something that we recommend they use it alongside.
Yeah, and we hear all the time diversify. I mean, you really want to diversify in the different financial pieces that you're investing in, as well as, in real estate. And it's just like in my space in the mortgage business, there is a great product for the right person, and there is a product that is not right for another person. And then there's a great product that could be great for someone, but it's not structured correctly because they're not working with an expert that can navigate them through that process. So important. So let's talk about, how are these policy cash values guaranteed?
They are backed in writing through a contract with an insurance company that's been around for 160 years. They've been doing this. And to take it a step further, insurance companies are highly regulated. They're regulated on a state and federal level on what they can do with their funds. And typically about 60 to 80% of their portfolio is in the bond market. And then 20 to 40% is in real estate, either real estate loans, or they give loans to other banks and other financial institutions. So pretty much they're in conservative banking, conservative loans. So the contracts are backed by insurance companies. They've been around, they've been in business for a very long time. And pretty much the way that insurance companies invest, they are not investing in high risk areas. And when there is a market crash, pretty much the insurance company isn't using premium dollars to invest in the stock market. Like if they were doing that, then when there is a market crash, then people's current values in their policies would decrease. Rather, they're investing in places that are not hindered by those. Pretty much insurance companies are really good at protecting wealth and have a proven track record for doing so, even during tough times. So if you do have a whole life policy and you have cash value in it, and then the market is heading south next year or this year even, then you can bet the cash value you have won't be affected by that. In a lot of situations, the cash value will still grow. It will still earn dividends and interest, while markets aren't favorable.
Yeah. So, and it is amazing. I'm really familiar with, and is this tied into the Index UL?
No, it's actually a completely different product.
Okay.
So typically when it comes to cash value life insurance, there's either whole life insurance or the universal life, like Index Universal Life.
Got it. Okay. So can one of these strategies that we're talking about today go alongside other investments for business strategies?
Yeah, absolutely. And we recommend that, definitely. So a business could actually own a whole life insurance policy as an asset on its balance sheet. They could pretty much use that to use the profits or use sales to grow the policy over time, and then be able to borrow from that to invest in marketing, to invest in advertising, to pretty much do different things while being able to recoup that. And I have a lot of clients that ask me, what's the point of doing that? What's the point of building up a whole life policy and then borrowing from that to use for marketing or advertising or different places? Why not just use cash like we've always been doing? And the answer to that is, if you, for example, have $10,000 in a bank account and then you spend $10,000 in a bank account, how much do you have now in that bank account? You've spent all that money and then you have to now save up all over again. Rather, if you have, for example, a savings account, like a supercharged savings account that's earning you 5% compound interest every year, and then you want to access that money, instead of pulling out from the principal, you could borrow against it at a lower interest rate from a different source, leveraging your current cash value or your current savings account, meaning that you can still earn compound interest on your money while still being able to use it. So it's not an either or approach. It's not either I save my money or I invest it. It's a combination of both. You can grow it, and then when you want to use it, you borrow against it from a different source, leveraging your current cash value. This is what banks do. This is what insurance companies do. And this is what we help our clients and investors do.
I would say banks are not in the business to hold money. They're in the business to lend money, and they're in the business to leverage what they have so that they can lend more money. Leverage is a really beautiful word, as long as you understand what you're doing and you're doing it in a smart and strategic way. So I know that there's some real tax advantages as well using this concept. Can you talk a little bit about that?
Yeah, definitely. So in all situations, the growth of the cash value in the whole life policy grows tax deferred. So if you're earning dividends and interest in the policy, you don't have to claim these on your tax returns, either in a business or on a personal level. And then in most situations, when you take that money out, you're taking out, it's tax free because you've already paid taxes with that money. So in most situations, For example, you work, you pay taxes on that money, then you deposit it into the whole life policy. It grows tax deferred. And then when you take the money out, it's coming out tax free. And then of course, the life insurance part, I know this is not about the life insurance. It's more about the investing and savings aspect, but still there is a life insurance part to it. There's a death benefit, and the death benefit is tax free.
Yeah. Sounds pretty sweet. So let's talk about, because again, it can't be the right product for everybody. So what would be the ideal person that would utilize a product like this as part of their investment portfolio?
Yeah, it's definitely, I think somebody who is kind of familiar with already investing, they kind of already have a savings habit, and they pretty much have a goal to save for the next 20 years. So if somebody's, 65 and they want to retire at 70, you could still leverage this solution. Definitely. We still have solutions for that. But I think in my opinion, and with the experience I have, it works better with people who have about 20 years to save, because we are dealing with compound interest, and compound interest is always better, yesterday than it is today.
Yes.
It's better, time is the key part of compound interest. So definitely somebody who wants to kind of save. And the good thing about this is there's different funding amounts for different people. So it's not like everybody has to be wealthy in order to use this. You could do this policy. You could use this structure with $200 or $300 a month. You could also use this with $1 million. There's no minimum, really. There's no maximum. And what we always do with all our clients is we do a full, thorough 60 to 90 minute financial analysis where we get to know the client. We get to know their financial situation. What do they do for work? What's their current cash flow, income? What are they doing for retirement? Are they real estate investors? To kind of understand where they're at financially and where they want to go. And then from there, we build out this infinite banking policy, or this bank on yourself type whole life policy, based off of what we uncover in the financial analysis. This helps us give a clear picture, a clear recommendation, instead of just guessing, what would be beneficial for this client. We give a specific recommendation. And then we also do 6-month reviews. So it's not just we stop it with one policy. We do 6-month reviews to test out the cash value, to see how it's measured with their other investments, and to ask, is all of this actually working? Is this heading in the right direction?
Yeah. And there's pretty sweet software that you can use as well to do all the different examples of what it would look like at this time frame and this type of rate. And so it's really nice when you see numbers. I'm in the mortgage industry. I actually own a mortgage software that I created because I love numbers so much. And really that's the key when you're educating and talking with clients. They need to be able to see the numbers, because the numbers are red or green. I mean, it's, so you can really analyze what that's going to look like. So what about geographic area that it's applicable to?
So we work with all 50 states, and about 99% of our clients are virtual. We do everything over Zoom or over the phone. Everything can be signed electronically. So pretty much we don't have any geographic restrictions, except of course, outside of the US. We only work inside of the US in all 50 states.
So a few more minutes here, a couple more minutes with you. And I would love to ask you, what do you see overall with people in finances, that they're making the biggest mistake that can cost them a lot of money long-term?
Yeah, I think one major problem right now across the US is that people aren't saving a lot of money. Actually, about 60% of Americans don't even have $1,000 in a bank account. And it's not an income problem, it's a savings problem. And I think it's a savings problem because our money is way too fast. It's too liquid, it's too fast. You have checking, savings account, you have mobile apps, debit cards, credit cards. It's very easy for us to access our money. And then, we have online sales, as already mentioned, online sales are soaring. So it's very easy for people to spend a lot of money online, or, even at home. There's no really obstacles around their money. And I think that people need, the solution to that would be to create some obstacles around your money. We need to kind of have financial vehicles in place that would pretty much, for every dollar you earn, you could pretty much put a portion of that somewhere. And then when you want to access it, like for example, in this case, using infinite banking, when you are funding a whole life policy and you're growing the cash value, every time you want to access that money, you would pretty much have to fill out a form, send it to the insurance company, borrow that money out. Yes. And then it kind of creates some steps between you and your money. And I think that's smart. You want to do that. Your money is accessible in 3 to 5 business days. It kind of makes you think a little bit more about using your money and what you use it for.
Absolutely. Well, we all know you shouldn't, if you don't have a debit card or use a debit card, or if you don't use a credit card, you're going to have more money. Mm-hmm. It's when you're only taking money that you actually have access to, you're going to save a lot more. Well, thank you so much for coming into the show.